Good afternoon and no, good morning. My apologies and welcome all to the webinar this year, again of IFRS 8 this time. It will be on operating segments today, where we'll give you a bit more insight in the standard that explains what it's about. Some practical information first. As always, we have made some logistics where you can see how we will go further. So everybody is automatically muted. It will be at maximum 1 hour and a half. If you have any questions, there is the chat in the webinar. So please raise your questions and address it to the host and panelists. You will receive a short poll after the webinar to evaluate ourselves, and everything will be recorded. So afterwards, you can always consult back on our website, Finvision Academy, and find the broadcast of this session, but also of previous sessions. The slides will also be available for download in the webinar app in a PDF format. Today's speakers are Sam Verfaillie, who will come back at the end, give you all insight and disclosures, and I will run you through the beginning of the basics of the standard and some definitions. An overview, so a lot of all sessions we are holding this year. So we already had IFRS 10 and 11 earlier this month and in May, and today we are at operating segments. For all of those interested in later sessions, we will be talking after summer holidays on IFRS 2, share-based payments, in 2 sessions. Afterwards, we go to IAS 24 in November, and we give an update on ESMA priorities in 2022, as well as IFRS updates that are applicable for 2022 closing financial statements. And just before Christmas, we will go through earnings per share. So a bit overview of what we'll be talking about on IFRS 8. First, a small introduction, then we'll define who is in scope of IFRS 8 and operating segments. Next on, we will be indicating how to identify a single set of operating segments, starting from the internal management reporting. And in the second step, then IFRS 8 indicates how to go from identified operating segments to reportable operating segments. And for that, there are the aggregation criteria, both qualitative and quantitative. And last but not least, the disclosure, because it's putting into practice what IFRS 8 is defining and how to measure it. So what is the core principle of IFRS 8? It requires entities to disclose further information that allows users of the financial statements to evaluate a bit more in detail. So it's the nature and the financial effect of the business activities and also the different economic environments in which it operates. So basically, IFRS 8 requires preparers of financial statements to give more insight on how the business is driven, how it's done by the senior executives that manages the business. We'll come back later on that, how that is defined, but it gives a bit insight on how people are managing their business. So readers of financial statements get also insight in that and can link that perhaps with the risk assessment they make. So who is in scope? Not everybody is in scope. It applies to both separate or individual financial statements of the entity, but also consolidate. But important, it is for those whose debt or equity are traded in public markets, or, so it's not a combination, it's one or the other. Those are filing or in the process or filing, for example, a prospectus, to be in a public market. So basically, it's mainly for listed entities, but the full definition is here. The test should be done on the parent company. So not if the parent company is not quoted, but some of the subsidiaries are quoted, then the parent company will not be in scope for IFRS 8. However, the subsidiary that is listed will then still have to apply IFRS 8 in their respective financial statements. How to identify now a single set of operating segments? Well, let's first go through some definitions. What is it? It's a component of an entity or group that engages in business activities which may earn revenues, and obviously also link back to expenses. It's regularly reviewed by the entities, and that's a common name we'll be talking about, the CODM, or the Chief Operating Decision Maker, that makes the decision on how to allocate resources or assess its performance, and for which discrete financial information is available. So there are three different components we'll dig deeper in now to understand what is an operating segment. So revenue earning business activities, it should have the potential rather than actually earning. So key, and I will go quickly back, is it engages in business activities that may earn revenues. Expenses follow in second order, so starting point is revenues or the capability to earn revenues in the future. So a startup that is still loss-making could be an operating segment, even though at this moment it might still not have revenues. On the other side, not every part is necessarily an operating segment. The corporate headquarters or some common department like treasury, for example, or other central departments, they do not earn revenues. So starting point, I said, was revenues. They might accidentally have some revenues, but most likely, but again, it will depend on facts and circumstances, that will not be in scope of IFRS 8. Similarly, if there is a post-employment benefit plan, that would not be considered as an operating segment either. You see, for both, triggering point is whether they have the capability or the intention to generate revenues, which is not the case for those two examples I gave, and that's why they're not considered as operating segments in most cases. Second part was looking at the chief operating decision maker. It starts from the function, so it's not necessarily a specific manager or a person with a title. It really looks at who is in fact allocating the resources or who is assessing the performance and what information is that person or those persons, because it could be more than one person, as I will explain later on. What information are they using? So it looks at the internal management reporting that is reported to that chief operating decision maker, and he or she or they use that information for two functions, the allocation of resources and the assessing of the performance. In a lot of situations, it will be the CEO or the CEO or the combination of both. That could be individuals, but it could be to a larger extent. For example, a group of executive directors. It could be the full board. But important, it will be an executive role. If, for example, you have a board including executive directors and non-executive directors, then question could be, is it at the board level? But if at the same moment there is a committee underneath the board where all executive directors or some delegate executive powers have been assigned to that, it's more likely to be in that committee than in the board, which is a combination of both non-executive and executives. So key is it's the most senior executive decision-making level, and it will be important to make the distinction of who is making the decisions and who is having an oversight role, like, for example, non-executive directors, which receives the same information to perform their oversight role, but is not making the decisions. So for IFRS 8, it's really important to look at who is making the decisions, referring to above, to allocate the resources and to assess the performance. You will see later on in the disclosures as well, there is a wide variety because obviously it depends on facts and circumstances. It depends on their own internal management reporting and also on the interpretation and the judgments. We'll come back later on that. The process of identifying it is highly judgmental. What is then the segment manager? And focus, as said, IFRS 8 looks at the chief operating decision maker, but we'll dig a bit deeper in that to make sure that by accident you do not end up on the segment manager to make that decision, but you really look at the chief operating decision maker. The segment manager is accountable to the CODM, and he or she will maintain regular contact to discuss the operating activities. In some situations, and then looking at the second point, the CODM may have the role of segment manager for one or more segment managers. In others, it will be a separate function, the CODM, compared to one or more segment manager. On the other hand, identifying your operating segments is important, and also aggregation is important to see how many segment managers there are. Because the way components are managed is important to identify what entities operating components are, and components and segments are. On the other hand, that refers back, it's not because you have a common segment managers that you can automatically aggregate them into one single reporting operating segment. Those have aggregation criteria, which we will come back later on. So chief operating decision maker is the key person or persons to identify, to assess what information is he, she, or they using to make the decisions. The segment managers could help to identify, okay, what operating segments are in place within the company or within the group. If we go further to the next slide, yes, let's look at an example just to give the indication on why it can be important. So we have a company or group where the chief operating decision maker receives detailed information, not only at divisional level, but also at the level of business units below. So important there will be to assess what is now operating segment. Is that the divisional level, or is that the level below of the business units? The fact that a chief operating decision maker gets more detailed information on business unit level is a clear indication that there is a possibility that it's at that level that he or she is making the decision. So in these circumstances, it will be important for the group or the company to see, okay, why is divisional level then relevant for operating segment, or why is business units? It could be that the more detailed information is not used to assess the performance and to allocate the resources. However, and that's listed here below, there is evidence that regulators and enforcement agency start from the presumptions a CODM will use any detailed information provided to him or her to make the decision-making and assessment purposes. So you could make the argument that even though he or she does get more detailed information, he's not using it, but the presumption is otherwise from the regulators in practice. The argument could be that segment managers only operate at divisional level and are in fact managers of each business unit. So there's no clear-cut answer. Everything will depend on effects and circumstances, but starting point is if more detailed information is given, assumption will be that that is the operating segment rather than the level above. The third point, what was important to identify was availability of discrete financial information. And I said, and it refers back, it is discrete information that allows the CODM to make decisions on two aspects, the allocation of resources, and I'm repeating, but it's the essence of IFRS 8 and the assess the performance. As soon as it relates to the profitability, the information of that comment, it could be considered as sufficient for the CODM to review its operating results and as such assess performance and allocate resources. If the information would be only on revenues, it's unlikely it is considered as sufficient because revenues alone would not assess the performance. You really go to a step below to the profitability. But what is profitability can obviously be different for different types of companies. It's not necessarily at profit after tax, it could be also at another way. There is no requirement to have separate statement of financial positions or a separate cash flow statement for components to be considered as an operating segment. So the process of finding an entity's operating segments is really starting from the smallest components of the business, looking at what internal management information and management reporting is provided, and which includes a measure of profitability provided to the chief operating decision maker that he or she will then be using to perform its function of allocation of resources and of assessing the performance. As said in the beginning, it's a highly judgmental process, so it clearly starts from a bottom-up approach to determine, okay, at what level of detail will we be looking, what is existing in the internal management information. And it's used on the same components that is used internally. So again, starting from what is the existing management reporting and how decisions are made there by the chief operating decision maker. Key challenges, at what layer is the entity's organizational structure representing the level of that they are using to manage the company. So there could be several levels used there, but the key question will be identifying what level is used to manage the business by the chief operating decision maker. If in practice, and probably it's common in a lot of companies, information in management reporting is presented in several ways, then finding the specific one that is used to manage the business could be challenges, especially if management structures it in both operational, strategic, and oversight responsibilities. Despite the different challenges that exist, in the end, IFRS 8 requires to identify a single set of components that constitute the entity's operating segments. Also important, there is a link with IAS 36 because IAS 36 refers to IFRS 8 and it says you cannot allocate goodwill to a group of CGUs or a CGU which is above the operating segment before aggregation. So identifying operating segments will also impact the level at which you can allocate the goodwill and also at which level impairment testing will have to be done. So the first step was identifying what are the operating segments. In the second step, IFRS 8 does allow some aggregation, but key criteria are set on how you can aggregate those and what operating segments are always required to be presented separately. So there are a number of criteria to consider. So there is size criteria. As soon as you exceed specific criteria, you will always be required to report them separately. Come back to that more in detail later on. Once you have identified a segment as being reportable, it considers to be disclosed separately as long as management judges to be it to be of continuing significance, even if it's below the criteria in the meantime. So once it has been reported separately, there will be another judgment if that reportable segment would decrease. It will be a judgment level. Is it still significant? And as such, it should be required to continue, yes or no. And then in the end, you can aggregate. However, as soon as the unallocated becomes too large, you will still need to continue to identify more than one reportable segment. We'll come back on that later on. So important, you can only aggregate looking at the different criteria and making sure that you meet them all of one. So let's walk to the decision tree, and then further on we'll go back in details in a number of those steps. So first one is the different parts I just explained. You have to identify what are the operating segments based on the existing management reporting system that the CODM, Chief Operating Decision Maker, is using. Then, once you have made that assessment, first step is to identify, do some of those operating segments meet all aggregation criteria? Those are qualitative aggregation criteria. If that is the case, you can start to aggregate different segments. And then move anyhow to the second step. The second step talks about quantitative thresholds. So as said, are you not exceeding specific thresholds which would require you anyhow to report them separately? If they meet the criteria and they have common qualities, you can report them as separable reportable segments. If they don't meet them, you can look at, okay, do they meet a majority of the aggregation criteria? And that's the same criteria you had in step 1. The final step here, if you have identified a number of separately reportable segments, do they account for at least 75% of the entity's revenues? If that's not the case, then even though all of the rest would allow aggregation, you still need to continue to identify, okay, which one should I report separately until you reach 75% has been presented as separately reportable segment. So the remaining part, which then can be combined in an all other segment, can only consist out of 25% of the revenues. So as said in the beginning, revenues is clearly the starter of the driving. So let's start with item 1. What are the qualitative operational aggregation criteria? So regardless of the size, you can combine 2 or more operating segments if they have similar economic characteristics. And those should be demonstrated in each of the following. So it's cumulative, it's not or, no, you should consider them all. The nature of your products and services, the nature of your production process, type or class of customers for different products or services, the methods used to distribute or provide them, and also, if applicable, the regulatory environment. So it's quite a long list. Important is them to consider them all. And if you want to meet aggregation criteria in the first step, you should meet them all. If you encounter it in the third step, then it's a majority that should be considered as being met. Second step was quantitative aggregation criteria. And here, as soon as any of the below thresholds are met, you should report a segment separately. First one looks at the reported revenue. As soon as you reach 10% or more of combined revenue within that operating segment, you will have to report it separately. So 10% or more, it's a separately reportable segment. Second one, if the reported profit or loss is in absolute terms 10% or more of the greater, and it will depend whether you look at profits or at loss, of the combined profit of all profit-making operating segments, then you should report it separately. If it's a loss, then you compare it to the combined loss of all operating segments that report a loss. And the last one, if assets of our operating segment represent 10% or more of the combined assets of all operating segments, again, you report it separately. So 3 different criteria, quantitative criteria, that could trigger the requirement to report separately. Start looking at revenues, looking at assets, or looking at the result, and then you need to distinguish. If it's a loss, you compare it to the combined loss of all operating segments making loss. If it's a profit, you compare it to the combined profit of all operating segments making profit. Aggregation criteria, that's the last step. If you're there, as said, the residual category which you combine and the other cannot exceed 25% of revenues. If you still exceed in the remaining category, those 25%, take a step back and look, okay, what segment can I report separately as well to make sure that the other category drops below 25%. It's important to present the other category from reconciling items, as will be explained by some later on. And then you look at in order to identify operating segments, you will have to present information starting from how it's included in your internal management reporting, which might not necessarily fully in compliance with IFRS. So what will have to be prepared is a reconciliation between how is your operating segment reported and how does that link back to the IFRS financial statements on, for example, revenues or any of the other lines. That is a reconciling item column to make that bridge, but another one could be the other. You cannot put both in the same column. So questions arise there. Headquarters, treasury, as said, that could be not a separate reportable operating segment. In what category should they fall? Is it the other or the reconciling? In fact, IFRS 8 does not give specific guidance on that. It's a matter of judgment and making sure that it's consistent year on year and that it's clear what is included in the other or in the reconciling category. IFRS 8 also includes a practical limit of number of rating segments. It's not clear-cut and hard-cut definition. It's a suggestion that the suggestion is there. If you would reach more than 10 separate reportable segments, you should consider if you're not at your limit and reconsider some of the judgments you have made. That is the key definitions and the process on how to identify what is the operating segments that exist based on the internal reporting and on basis of which the chief operating decision maker makes his or her decision. And also then the next step, what are the possibilities to aggregate yes or no once you go to the separately reportable segments. So we'll continue further and give you some further guidance on what is the requirements on the disclosure and some practical examples which we'll see in real life.
Okay, thank you very much, Hans. So let's go to the disclosures and let's try to use examples and to show you the requirement of the disclosures by means of an example. By the way, there's a valid remark on that slides are not posted. So in the meantime, they have been uploaded now to the handout section. So you can download now the slides. Apologies for this. Okay. There are 4 levels of disclosure requirements in IFRS 8, and I think this is, what Hans explained is defining the reportable segments and doing the necessary aggregations. That's one judgment that needs to be made, but also how does this reflect in all disclosures? And I think that is something that really needs to be considered also. You have 4 levels. You have the general principles, which will be like a kind of accounting policies explaining. We have information about the reported segment. So reported segment is the operation segments, but if those aggregated, those are the reported segment. For profit and loss, the segment assets, segment liabilities, and the measurement basis. You will see also in 2 that very often companies don't disclose the segment assets or the segment liabilities, or they have a different measurement basis for the profit and loss. That's what we're going to explain. What Hans also explained, the first starting point is always is your internal reporting to the chief operating decision maker, and on what basis, what kind of reporting, of what form of the reporting, how discrete it is, will the decision be made, and that will be your basis to disclose also the information. Thirdly, and that's also explained because we can have a different measurement basis, we need to reconcile always to the totals of segment revenue, the segment P&L, which will be your segment P&L, not necessarily net profit, but it can be, for example, operating profit or loss or EBITDA or even another level, segment assets and liabilities to the first table, to the primary tables in your financial statements. And then fourthly, we have the entity-wide disclosures that you always need to disclose. Even if you only have one operating segment, you will need to disclose the entity-wide disclosures. Some of them will be already part of IFRS 15 also. You will see that one of them is about product and services. That's also a requirement of IFRS 15. So what are the general principles? The factors that you have used. So it's how did you come to your reportable segments, those that you're going to disclose? What are the factors that you have considered? Is it on what basis of the organization? How is management organized? How are they looking? How is the chief operating decision maker looking at the performance of the segments, and how are they making the decisions? And this can be by product or services, they can be geographically, they can be by regulatory environment. For example, if I look to ELIA, they will have a regulatory part and they will have a non-regulatory part. Geographical is very common, but also different product and services is also very common. And I will show you all the examples. It can also be a combination. It's everything is going to reflect how the internal management reporting is delivered to the chief operating decision maker. Of course, you will make some judgments. Like always in IS1, also judgments need to be explained, and that's also the judgments you have used in applying the aggregation criteria. It can be the qualitative aggregation criteria, but also the quantitative aggregation criteria. Quantitative, which is more straightforward, this will not be really a judgment. And then also you need to explain the type of products and services from which each reportable segment will derive or will obtain its revenues from external customers. So you will have to explain it. Basically, that will be the first part. So let's look at some examples. The first one is, I think, from Telenet, what they're explaining. And I've highlighted a bit in blue. They say, well, in Telnet, segment information is based on geographical segments, and it's consistent with the information available and made available to the chief operating decision maker. What you note here, also, they don't define the chief operator. It's not Telnet, it's MBEF. You see already the name, so it's not by product, for example, it could be by alcoholic beverages, non-alcoholic beverages, other things. No, it's by geographic, and it's the chief operating decision maker is not explained, and that's also important. IFRS 8 does not require you to explain who is the chief operating decision maker. Is it an individual? Is it a committee like the executive management committee or the board of directors? Although there have been some interpretations requested. So there's an interpretation that has been considered is, do we need to disclose the chief operating decision maker? It has been directed to the ISB as an improvement. It is still a project. There has been an exposure draft in 2017, but it has never been continued for the moment. So for the moment, IFRS 8 does not require it, although if you see it, it is good practice maybe to explain to the users who is the chief operating decision maker. But you see in a lot of cases that they don't explain it. And here in this case, they have 6 segments. They explain how it's done. And that's how they monitor the managing the performance and the risk and the effectiveness of the operations. That's one, that's MBEF. The other one is, I think it's Umicore, where they clearly explain what the business groups that are their operating segments and what they clearly explain. And so they have catalyst, energy, and service. This is by product and service, for example, and they explain what they're doing in each of the segments, which is one of the requirements to do so. Okay. I think this one, you see it, this one is from Telenet. Again, they say, well, this is the CEO, the chief operating decision maker. So they explain it, and they say, it can be surprisingly, but they only have one single operation because, and then they explain the judgment they have made, because they have a fixed and mobile conversion strategy for residential, but also business markets. You see the example. So they say we only have a single operation. Can be surprising because you could think, well, but maybe they still have at least residential and business as a distinction. I'm also wondering if the chief operating decision maker does not only look to Telenet as a whole and not to residential business and has more granularity. But that's how it's explained and how they have finally arrived at one single operation, which is the company level, the group level. This is a very high level. You don't see it very often with mature companies. You can see it, for example, in biotech. There you will often see only one level. They have one product. It's in a specific product line, a clinical product line that they're looking at, but they're developing their different trials. So this is common, but it's not so common for mature companies who have a lot of different products and services. This is one, you see it differently. We had Telenet, and this is the one for I think it's Proximus. You see it on the colors. And here it's important. One of the elements is also explaining also if there have been changes. And if there have been changes, and I will come back on that also later on, you also need to explain the changes to your operating segments this year, current year, compared to prior year. And here again, they explain the segments. Again, who is the group? It's a chief. It's here in this case, the chief operating decision maker is a group, which is the Proximus Executive Committee, and they have three reportable operating segments: domestic, international carrying, and telescience. And they also explain how they look at it from a point of performance, which is EBITDA. But I will come back on that also. It's EBITDA net of incidentals. Which is in this case not the EBITDA that you will see on the, or that you would calculate from the face of the statement of income. But I will come back on that later on. And that's the last one, I think. This is Vodafone, and it's sometimes difficult to see always whether there have been aggregation done. Often if there's no aggregation, they don't mention anything. And here they say, in this case, we have aggregated, probably this is a quantitative aggregation, the smaller operating segments into other Europe and other market reporting segments. That's the other category that Hans was also explaining. All right. Then secondly, we have the quantitative disclosures. The first part was, like I call it, is more explaining accounting policies. How is the measurement done? Secondly, you need to disclose. It can be very often this is a standard P&L that you see or a standard balance sheet. But mostly this is a selection of certain KPIs from the statement of income and from the statement of financial position, with very often different measures. Not what we call the non-financial the non-standard performance measures that you will also have to explain in how you have arrived at them. But let's see here the example. Again, this is, I think, the example. Again, yeah, this is the example from AB InBev. So you mentioned the operating statements were by geographical basis. And what you see here, what you need to mention, this is the requirement. There's a minimum requirement of the revenues from external customers and also the revenues from transactions with other operating segments of the same entity. In this case, they only have one revenue line, which you could interpret that within each segment, there's no inter-segment revenues between the different geographical areas. Or it could be that they have chosen that this is not material and we will not disclose it is the inter-segment revenues. But that we see always with the two comparative years that you will need to explain. So revenues. Secondly, always requirement is the depreciation and the amortization line that you need to disclose. You need to disclose interest revenue and interest expense. Here you see also that they combine it. Even they combine it, and I know why. Because it's not part of the measurement basis of the segments. You see that the segments, if it's it will show that, you see that the basis is the profit from operations. If I go, let me go to a good slide. I see it here and above, profit from operations. This is the lowest level that we will disclose the measurement basis of P&L of the segment. So this is the measure, the segment P&L, segment profit, what we call. So here that's important is that if it's not included in the management reporting to the chief operating decision maker, how resources are allocated to the segment and how decisions are made, then of course, even if it's a requirement that the segment disclosure need to include that, you don't need to disclose it, because always look to how management reporting has been delivered to the chief operating decision maker. And I must say, very often companies stop at operating profit. This is a very common measurement basis for a segment. Often you can see sometimes more detailed, but it's not so often. Also important for interest, revenue, expense. And I think this is important probably for financial institutions, but you should report the interest revenue separately from interest expense, and unless a majority of the segment revenues are from interest. And very often this can only be in a financial institution that a lot of the revenues are primarily of a certain segment from the interest. And also the chief operating decision maker relies on the net interest revenue to assess the performance. So this is the little exception when you don't need to split interest revenue and expense. The share in the profit or loss of the associates of the joint venture. This is also one that you need to explain. Here again, you will see it, it's part of the reconciliation. It's not part of the segment. If you would go lower, if you would go, for example, to net profit before tax as your segment basis, then you will have to disclose it separately for each of the segments. Income tax, same thing. And then this is the non-P&L, and very often that you don't see, this is the total segment assets and total segment liabilities. In this case, we only show the segment assets, which is the non-current, because this is the only KPI that has been included in the internal management reporting, meaning that the internal management reporting by segment does not include a balance sheet. It will only include the non-current segment assets and only gross capex. That's why we only disclose that. Although the requirement is, if it's part of the management reporting, you need to explain total segment assets per segment, total segment liabilities, and the capex. What you also see here in this case with InBev, they have non-financial performance measures, which is volume at the top and FTE, because again, it's part of the internal management reporting to the chief operating decision maker. So you need to also include it in your segment disclosure. Really, it needs to be aligned. There's some items missing here, but this can also be because it, but should only, so like I said, it should only be disclosed if it's part of the measurement basis for the segment profit and loss, which is reviewed by the chief operating decision maker. Examples are material other non-cash items besides depreciation and amortization, material items of income expense, which are disclosed in your statement of income, but are not disclosed here, or the total amount. This is your carrying value of the associates and joint ventures, which are accounted for based on the equity method. So this is, if this is available again, then there is a requirement to include that. Okay, yeah. Oh, that's what I already explained. So the line items that you see are non-financial and financial performance measures, but which are not derived directly from IFRS. But they are included again in the management reporting, so you need to also include it in your operating segment disclosure. Important here is always that if this is the case, because it's a non-financial or financial non-IFRS basis performance measure, if it's financial, non-financial related, you need to explain it. So again, very often what you will see, there is a glossary in the annual report, and this will explain how volume is determined, what is the normalized EBITDA, how is it really calculated, what is the closest IFRS basis. For example, normalized EBITDA, closest IFRS basis will be normally profit from operations, operating profit. So that are requirements that you need to explain in your financial statements. And this is an example of a more detailed segment disclosure. What you see, in the previous one, you mentioned revenue, depreciation, and then EBITDA and profit and operations, but not the lines in between, although they are also presented in the statement of income, but it's not part of the reporting to management. In this case, you see much more detail, which is more aligned with the P&L. With the P&L. I'm not sure from which company this is, but here you also see this revenues intersegment, which we didn't see with MBEF. We see also the equity accounted investments, which was also the requirement, so the carrying value, and the non-current segment assets, what you see in addition. The segments here are really based on a region again. And this is again from Umicore, I think, which is the most detailed one that I have seen. Although there's another one that I will show later on, which is very similar, which is from Bekaert, which goes also very much in detail. But here you see again a lot of non-financial or other non-IFRS performance measures like capital employed, average capital employed, the ROCE, return on capital employed, R&D, etc. So adjustments, those are all non-IFRS related items which will have to be explained. And here you see also the operating segments by product or service, catalyst, energy service, or recycling. Then the measurement basis, like Hans explained, you need to reconcile. And again, very often the measurement basis is fully IFRS aligned. Very often it's one-on-one to IFRS, but it is a non-IFRS measure, for example, EBITDA, but there's a one-on-one link. There's no other adjustments done, which could not be derived from the statement of income. But often also you have a measurement basis which is non-IFRS, which can be management IFRS, which can be IFRS but with some adjustments done. I will show you also an example. And that's really, even if, for example, if the management reporting would be Belgium GAAP, for example, but you need to report under IFRS, then your IFRS disclosure will be, your IFRS 8 disclosure will be Belgium GAAP, and you will reconcile to IFRS. You will not see that in the Belgium GAAP IFRS, but very often you may see a different measurement basis. Some, for example, IFRS 16, which has not been applied in the or accounted for in the management reporting, because it's a bit artificial sometimes for the EBITDA, which is the measurement basis of profit. So that's why they exclude IFRS 16. So it's non-IFRS compliant, and you will have to explain it. So you need to explain the basis of accounting of any transactions between the segments, your inter-segment revenue, the nature of the difference between the measurement basis. So this may be non-IFRS measurement basis, non-IFRS adjustments. The changes to the prior periods, I showed you already the example of Proximus, but also if you have certain allocations done, it could be that you do allocations which are not symmetrical, on a basis which is based on a parameter within the P&L, like revenue, gross profit, EBITDA percentage, then you need to explain that also. So the asymmetrical allocations, for example, of depreciation expense, need to be allocated. I have allocated everything to one segment. You need to explain that because it's not symmetrical to the different segments. Voila. This is again Telenet here. What I'll show you, where we see that they say the performance sort of case is based on the overall profit statement, and we use adjusted EBITDA. Although it's a bit different, because if you then look to they don't mention adjusted EBITDA as a line item. So sometimes it's a bit confusing here what they mention. That's another example, and what I think what is important here is that they explain the capital employed items, how it's defined. It's also in the definitions or the glossary, but also they mention any sales between the segments are transacted at the prices which reflect the at arm's length principle, which is one of the requirements also to explain. And intersegment mainly includes elimination of receivables, payables, of sales or margins of transfer inventory, and etc. That's a Norwegian company, Equinor, recently came into the news because they will do something together with Fluctis, and that's how they say it. They have changed their reporting. What you will say, if you change reporting, you need to apply it retrospectively. You need to explain. You need to change your numbers retrospectively. That's important. And they say the new reporting structure has been applied retrospectively with comparative figures reclassified. So you will have to explain on the prior year. You need to show the prior year based on the new reporting structure. They mention the intersegment sales and the unrealized profits, how it has been determined, and the measurement basis, which is the segment profit, which is net operating income loss, which is something directly derived from the statement of income. But they say the measurement basis for segments is IFRS applied, but then they do adjustments. And that's what they explain. They did not have applied IFRS 16 leases, and the line of item additions to property, plant and equipment, intangibles and equity accountant investments. That's what that are the exceptions which are not IFRS compliant, and what they will reconcile then as of part of step 3. Okay, you see it here. They mention all IFRS 16 leases are presented within the other segment. So they have a different non-IFRS measurement basis for profit, which we will have to explain. Everything which is not directly derived from the statement of income or the statement of financial position, you will have to reconcile always. So you need to reconcile the total revenue from reportable segments to the total revenue from a statement of income. The total profit or loss for reporting segments, which can be, for example, can be not net profit, but can be operating profit, to your statement of income. The total reportable assets to your total assets based on the statement of financial position, liabilities, and every other item that you mention. There are different ways to do the reconciliation. If you look, that's a simple one, which is very see often. I think this is Vodafone. They do the segment disclosures until adjusted EBITDA AL. I will come back on that because this is a very interesting measurement basis where a lot of companies are maybe struggling with. But adjusted EBITDA AL, and they will reconcile to their operating profit, because EBITDA, even if it's EBITDA, it's not an IFRS basis. You need to reconcile to something that can be derived directly from the statement of income. In this case, this is operating profit. So you reconcile and you explain all the adjustments that have been done to come to reconcile with the operating profit. And it will go until net profit in this case. I didn't copy anything, but basically you're reconciling to the operating profit. I mentioned EBITDA AL. I will just, this is for info, but this is an interesting one. It's a non-IFRS management basis, but how they define it, and this is the operating profit after depreciation on lease-related right-of-use assets and interest on leases, but excluding, there's a typo, depreciation, amortization, and some other elements. But I think this is an interesting one because the IFRS 16 is influencing significantly the EBITDA and doesn't show a correct EBITDA anymore, because EBITDA, which is a measure for non-cash, for the cash flow, but if you eliminate the IFRS 16, there's still a monthly or a yearly cash flow going on, which is your monthly payments, or so that's why they very often they're adjusting that. But I think it was interesting show, nothing to do with IFRS 8, but you can see the non-IFRS performance measures only in IFRS 8 or in the press releases, but this was an interesting one, which may be useful maybe for other companies to include. This is Proximus, and that you see you need to look from the right to the left. On the right, you have the underlying segments, which are your segment disclosures. This is the segment disclosure. We had domestic, BICS, Telesign, and then we had the eliminations to come up. And then this totals up to the column underlying, which is the fourth column in the table. There's some rounding errors. If you start calculating, you will see that there's rounding errors of 1. But yeah, this can happen very often. What you see is their IFRS, or their measurement basis, is operating income before depreciation and amortization at the bottom, and that they're going to reconcile. We have at the right side the underlying segments, the total of the underlying segments, which is the underlying. For example, operating income before depreciation and amortization, which is it is 1 billion, I think. Yeah. 1,772,000. No, 1,772,000,000. That's the right amount, I think, for Proximus. And then they're reconciling. We had 2 adjustments, which is the incidental. Incidental is more the non-recurring. Again, this is explained in the glossary, how it's defined and how it's calculated. And we have the lease depreciation and interest. Similar like in Vodafone, they're also excluding it from their segment basis. They're deducting it again, and they come up with their operating income before depreciation and amortization, which is 1,828, which is higher. It's the calculation with the signs is from the left to the right, although in a reconciliation you would go from the right to the left. That's how we see. And that's how we see it. And then they reconcile the total to operating income, and that's how they have defined, performed their reconciliation. So two ways, in the Proximus way, or we can do it also in the Vodafone way. You see both happening quite a lot. See it here, the segments, and this is the reconciliation. And then finally, we have the entity-wide disclosures. Entity-wide disclosures, even if you have one segment, you need to disclose them anyway, always. And these are 3 levels. It's the revenue information about product and services. I think this is, I'm sure this is also one of the requirements in IFRS 15. So this will be aligned. Not necessarily this will be part of the IFRS 8 disclosure note, but maybe part of the IFRS 15 disclosure note. It doesn't matter in which note you mention it, it should be just disclosed. Important also here is that it should be based on the same measurement basis as in the statement of profit and loss. So not necessarily you will align it with your measurement basis in the operating segments. So that this is different measurement basis, can be a different measurement basis than the operating segment disclosures. Revenue and non-current assets on a geographical basis. This is sometimes revenue is not an issue. Non-current assets may be an issue. They have 2 ways to look at it. You can be based on the location of the entity. For example, I have a subsidiary in France, and that will be the French revenue and the French non-current assets. But it can also be on the basis of the customers. Where is the customer located? Belgium. I have only one entity. Belgium is selling to Netherlands, Germany, Belgium, and France. But I have only one entity. I will mention the geographical revenue from Netherlands, Germany, Belgium, and France, for example. Important always, you need to always disclose the revenue and the non-current assets for the domicile country of the entity. So in this case, always Belgium, we have to explain it separately. Even if it's not really material, you will have to explain it separately. And then you have your total all other foreign countries. And then every country which makes up more than 10% of the total external revenue, you need to explain it separately. Very often, what you will see the examples, we have countries, but we can also have regions, for example, Europe. But taking into account, I think you need to take into account the 10% threshold. It is an example. I don't think it is a requirement. IFRS 8 mentioned it as an example threshold. Also, but I explained, the revenues can be based on the location of the entity that is selling or the location of the customer. You need to explain the basis how revenues have been allocated to the geographical basis. And then revenue information on major customers need to explain. If I have a customer which is the 10% here is explicitly mentioned, which is more than 10% of the total revenues, you need to explain not the name of the customer. This is not a requirement, but you need to explain I have 3 customers which each represent 10, 12, 30% of total revenue, for example, for 2021, and then same percentages for 2020. Again, customer name is not required. You don't need to mention it per segment, per reportable segment. That's not a requirement, but sometimes you see that they mention it, and sometimes you see that they also put it by reportable segment, but it's not a requirement. So let's look to the examples. This is really the total segment turnover, total non-current assets by region. And here they have combined regions, Europe, and always need to explain. You need to explain the revenues and the segment assets on the domicile country of the entity, which is Belgium in this case. So of which Belgium, that's your domicile, that they mention it. Asia Pacific. They even mention additional information here, CapEx, employee compensation and benefit income taxes. But this is not a requirement. The requirement is only segment turnover and non-current assets. If you look on to information on product and services. This is, I think, again, Equinox that they mentioned in 2021, and this is an energy company. You see it, and they have extraction of crude oil, natural gas, refined products, natural gas liquids. That they're product and services that they're explaining, not by segment again, but you need to explain it, your revenue split. It's not or geographic or product and services. It's really and geographical and product and services. Important to know. And that's an explanation of the major customers. How you see it, this is an entity that explains the names of the customers, but also putting it in which operating segment it is related, which is not a requirement. But that's how you would look at it. So again, it's a 10% threshold that you need to apply on total, not within the segment, but on total revenues, which is derived from your statement of income. All right. And then lastly, restatement of previous periods. Like I said already, when you change the reporting structure, when you change your management reporting, then and your operating segments change, and how you present and your measurement basis change. Measurement basis change because of those changes. You need to apply those changes retrospectively. So you will have to restate your prior periods IFRS 8 disclosures. It's about segment measures, again, organization structure. There's an exception, of course, like we have always, unless it's so excessive cost to make the restatement, then you don't need to do it. But then you need to mention the current year in the old format, the old way, consistent with the previous period, and the new way. So there should be the reader of the financial statement should have a clear explanation or insight and what the effect is of the changes in the reporting segments. All right. I think a bit earlier. Let me see. Than we expected. It's also a small standard, and what you see is, you see it in the examples. There's a lot of diversity in practice, and sometimes what you see, how it's mentioned, the segment disclosures, sometimes you can mention a question, is this really right? Is this really the reporting segment where the chief operating decision maker is making decisions on? But let's assume this is all correct, because everything has been audited, of course. But that's important to see. There's a lot of diversity on the measurement basis, on how you present it. And really important to know, it's really derived from your internal management reporting, which can be another gap or another measurement basis than your IFRS, and everything. It needs to be one-on-one with your management reporting. And very often this will also align how you explain the business and the performance of the business in your press release. That's very often, that will be very much aligned between both. All right, I think I am at the end. There's no questions, so maybe we were very clear, or maybe it is a difficult topic, or maybe everybody is hungry and they don't want to wait. But that's it. Thank you very much for attending. And like Hans explained, next session is IFRS 2, 15 September. So maybe, hopefully, to see you there, or to hear you there, or to on this webinar again. Thank you. Bye-bye. Have a good day.